So if you were to ask me, the bear market of 2022 is only just beginning, right? With raging inflation, rising energy prices, rising interest rates, and now international conflict involving Russia and Ukraine, and possibly more countries to come, the current environment that we're in right now definitely does not look very bullish. And so far this year, the S&P 500, at the time I'm recording this video, is down by 13%, and the NASDAQ is down by over 20%. Now, the technical definition of a bear market is when a major market index declines by more than 20%. So we are already there with the NASDAQ, which is mostly tech stocks, right? And we are definitely getting very close with the S&P 500 and the other major indexes too. And so naturally, of course, any kind of bullish option selling strategy, which have been working for the better part of the past 13 years, those strategies are no longer working, right? So if you are still selling covered calls or cash secured puts or put credit spreads, etc., my guess is that you're not doing so well this far in 2022. And again, if you were to ask me, I think this bear market is only just getting started. So definitely watch this full video because I'm going to show you exactly how you should be selling options in bear markets. And through my discussion here, I'll be talking about the two major characteristics of bear markets and how that's going to impact your option selling approach. And also, I'll be doing a lot of comparisons with the last real bear market that we saw back in 2008 and 2009. And in that way, hopefully by the end of this video, you'll be much more well equipped to handle and trade through this incoming bear market of 2022 and possibly beyond. Now, as always, before we get started here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Okay, so with that being said, now we're going to jump on over to thinkorswim here and we'll get things started. All right, so now let's talk about the two main characteristics of a typical bear market. And we'll start off here with the very obvious one, which is the fact that over the course of a prolonged period of time, stocks do decline. Right, so for example, in this chart here, I'm showing you SPX. This is the S&P 500 index. And this one view here shows you the entire decline of the 2008-2009 bear market. And obviously, as you can see here, stocks declined in a very significant way over the course of well over 1 year. And actually from top, right around there, from the highest price before the crash, which was at the tail end of 2007, comparing this price to the bottom of the bear market just after the end of 2008, the S&P 500 was down by over 57%. That's a huge, huge decline. And again, keep in mind right now, as I'm recording this video, the S&Ps are down by only 13%. So if this current bear market environment that we're in right now does continue to play out over the course of this year and possibly into next year, then there's obviously a lot more room to the downside for stocks to continue falling. And actually, even though the major market indexes are not down by too much, at least yet, there are still a plethora of stocks that have gotten killed in the past few months here. So very briefly, to give you a few examples of that, let's change the time frame on this chart back to a simple 1 year, 1 day chart. And let's first take a look at Peloton, PTON. And there you go. As you can see in the past year, this stock has fallen from a price of $130 per share, now down to a price of only just over $20 per share. So that's a decline of well over 80%. And in my opinion here, Peloton is not done yet. It's probably going to fall even further. And what about some of the other COVID beneficiaries like perhaps Zoom? So ZM is the ticker symbol for that. This stock has fallen from a price of over $400 per share, now down to under 100. So that's a decline of about 75%. And even now, some of the big blue chip companies are tanking as well. What about Facebook or Meta Platforms? Again, very similar story here. This stock has declined from just under $400 per share, now down to about 190. So that's a drop of about 50%. And believe me, this list does go on and on and on. There are literally hundreds of stocks at this point across a very wide spectrum that include blue chips like you're seeing here, or SPACs, recent IPOs, and everything in between that are down by huge, huge amounts. And in my opinion here, I do think this current bear market environment is only just beginning. So the first takeaway here is to use bullish positions very, very sparingly, and also with those positions have very, very strict risk management. So for example, unless you are still very, very focused on the long term, 5, 10 plus years out, I personally would not recommend using strategies like selling cash secured puts or selling covered calls, basically any kind of bullish strategy that has naked downside risk, right? Which basically means that your losses to the downside, if stocks do continue to fall, are going to continue to increase and get bigger and bigger and bigger until potentially the stock hits zero. So if you still want to use some bullish positions, which is totally fine, even in a bear market, then perhaps consider using things like put credit spreads or call debit spreads, right? Because those kinds of strategies have limited risk. Even in the worst case scenario, if the stock goes to zero, you're only going to lose a very small, limited amount of money. Or if you still do want to sell covered calls or cash secured puts and things like that, then perhaps consider using stop losses. Right? For example, if you sell a covered call on some stock and the stock goes down by 20 or 30%, perhaps consider simply stopping yourself out and moving on instead of holding the bag, so to speak, and potentially having the stock go down by 50%, 70, 80, or even more. Or one more possible approach you can consider, which is my personal approach, is, I still sell naked puts all the time, but if the stock drops below my put strike, I will short 100 shares of the stock. And therefore, that covers the put contract if I do get assigned, and I still have the potential to make a profit on the trade. Right, so very briefly to give you an example of that, let's come over here real quick. And this is my trade tracking spreadsheet for the current month of March 2022. And if I come over to the left here, you can see I have my trades organized by their position type or their strategy type. And right here, these are all the short naked put options I have sold so far in the month of March. And the ones that are in black still are still currently ongoing. And the trades that are highlighted in green or red, those are the trades I've closed already either for a profit or a loss. So naturally the ones in green here are the ones I've made money on. And then so far as you can see here, fingers crossed, I have not had any losing trades in the month of March yet. But for example, if you focus on this trade right there, this one was on UAL, which is United Airlines. And for this trade, I sold 2 put option contracts with a 39 strike. And now if we come back to thinkorswim and let's take a look at UAL, and then we'll go ahead and zoom in on the chart a bit here. So it was literally at this point on this day where I sold those 2 put option contracts. And again, keep in mind, my strikes were right there at 39. But obviously, as you can see here, United Airlines continued to fall again and again. And so far, it has come down to a price of about $30 per share. So even though I was initially playing for a short-term bounce right here off this major support level, or I should say former support level, even being completely directionally wrong on the trade, I was still able to walk away with a small profit. And that's because, again, once UAL fell below $39 per share, I shorted 200 shares of stock, right? 100 shares per contract. And therefore, the gains I made on that short stock all the way down here more than compensated for the losses I was facing on those short put options. So therefore, the net effect was, again, I still walked away with a small profit. So ultimately here, regardless of your particular trading style, just make sure that for your bullish trades, you do have very strict risk management, right? You don't want to be caught in a situation like this where the stock just continues to plummet more and more and more, which therefore causes your losses to simply get bigger and bigger and bigger. And so with this in mind here, that also means during a bear market, you should consider placing a lot more bearish trades, of course. So that would include things like selling call credit spreads or buying put debit spreads. Or in my case, for example, I've been selling a lot of short naked call options, and so far they've all made money. So perhaps consider doing that as well. But again, keep your risk management very, very tight. So like I showed you here with short put options, if the stock falls below my strike, I will short the stock to cover the contract. And then conversely for selling naked call options, if the stock rises through my strike, I will buy shares of the stock. But again, coming back to my trade tracking spreadsheet for the month of March so far, as you can see here, these are all the short naked call options I've sold so far. So I've been selling calls on Alibaba, Etsy, Cloudflare, Splunk, US Steel, Occidental Petroleum, CrowdStrike, etc. And like I said, thus far, they have all made money. And then finally here, in regards to this first main point, as you can see down below, so far for this month, I've only made 3 trades that were short strangles, which is basically a combination of selling both an out-of-the-money call option and an out-of-the-money put option. And they're basically the same thing as an iron condor, except I'm using naked options here. So also in a bear market, you want to use directionally neutral strategies very sparingly as well. And that's because the second major characteristic of a bear market is you will see a continuous elevation of implied volatility. And as you'll see here, this is actually very bad for a directionally neutral option selling strategy because these kinds of strategies mostly depend on implied volatility to contract, not expand. And implied volatility, in case you're not aware, is simply a measurement of uncertainty about a particular stock's future. And this uncertainty is quantified in terms of a percentage, because more technically speaking, it actually corresponds to a future expected price range. But the most important thing to understand here is that implied volatility is baked into the prices of option contracts. And specifically, as implied volatility increases, or as uncertainty about the future increases, that's also going to increase option prices. And then conversely, as implied volatility or uncertainty comes back down, that's going to reduce option prices. And then, of course, as an option seller, the main thing you want is for the prices of the options you're selling to come down in price. So that means you always want implied volatility to contract. And the good news is most of the time implied volatility does usually contract, but again, in bear markets, it mostly expands. And so now if you focus back on the charts here and come to this flexible grid tab, what I'm showing you is a side-by-side comparison of the S&P 500 index alongside the VIX index, and in particular during the bear market of 2008 and 2009. And so the VIX here is an index just like the S&P 500, but the VIX measures the implied volatility for the S&P 500. And therefore, it's also a great measurement of, generally speaking, option prices across the market. And so if we first look at the tail end of 2007, right, and the S&Ps were mostly trading sideways, but this was the very, very beginning of the eventual bear market that was to come. And if we look at the corresponding time period on the VIX chart, you can see the beginning of a very prolonged expansion of the VIX. And then once the bear market really started to take hold, pretty much at the very beginning of 2008, we therefore saw lots of rapid expansions of implied volatility, and therefore rapid expansions of option prices. And this kind of thing is especially harmful for directionally neutral strategies like iron condors and short strangles because, like I mentioned, these strategies mostly benefit from a contraction of implied volatility. That's the main thing you're shooting for when you make these kinds of trades, right? Because if the stock does indeed simply just move sideways over the course of an iron condor trade, that's not going to make for very quick profits. And that's because as the stock moves down, for example, you're going to lose money on the put side of that trade, but make money on the call side. So those two things are going to offset to a significant degree. And then conversely, if the stock rebounds and moves higher, same thing. You're going to lose money on the call side now, but make money on the put side. And again, those two things will offset. So that's why for an iron condor or a short strangle, you're mostly just playing for time decay and implied volatility contraction to reduce the value of the contracts you have sold. But like I'm showing you here, if implied volatility continues to expand or at least stay elevated, then you're going to struggle a lot on these directionally neutral kind of trades. And then in the worst and final part of this bear market back in 2008, we saw a massive explosion of implied volatility across the board. And it wasn't until a bit early on in 2009 where we finally saw a sustained contraction of implied volatility thereafter. And all this here basically corresponds to the recovery that we saw in 2009. And also because of all this implied volatility expansion, which is exactly what we're seeing today, right? For example, if we fast forward on this chart to right now, or to the recent past couple of years here, as you can see right there, this was the explosion of implied volatility back in 2020 once the COVID pandemic started. And then in very, very recent times, basically since the beginning of 2022, look what's happening again. Now that, in my opinion, we are beginning a more prolonged real bear market, we are seeing a continuous and gradual elevation of the implied volatility and therefore of option prices. So that's why to try and get around this implied volatility expansion that we're seeing, that's why I'm avoiding a lot of directionally neutral strategies in favor of being much more directional. Right? For example, if I sell a naked call option and then implied volatility expands further, well, that expansion is going to hurt my position, but if I do get the directional move correct on the trade, if the stock comes down, that's going to more than compensate for that implied volatility expansion. So in summary here, directionally bearish strategies should be your go-to, your primary focus, because again, that'll take advantage of the general down move in stock prices, as well as help to counteract the expansion of implied volatility. And then the second strategy type you should consider is directionally bullish strategies. But of course, you want to use them more sparingly, or with less frequency. And then thirdly, after you've already considered a bearish trade or a bullish trade, only after that point should you consider a directionally neutral trade. And also, of course, and this should be applied to any trade that you're making, but especially for the trades that have a bullish component to them, either an iron condor or a put credit spread by itself, etc., always keep very strict risk management, right? If this bear market does actually continue to play out, do not let your losses get out of control. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.